Hello and welcome everyone. This is Doug. I'm here for another swing presentation on a very specific topic. We'll obviously get right into it, but just so you know, a reminder, this is a recording. I'm not here live. I won't be asking any questions and I won't be able to answer any questions. Not that you have any sort of chat to type the questions in, but just to be clear on that. Okay, so the disclaimer you all know, but got to do it. Nothing presented in this webinar video presentation, vocally or visually, is to be taken as trading advice. Everything in this presentation is for educational purposes only, and of course, you should always consult your broker or financial advisor before placing any trade, and hopefully you're consulting your own knowledge and the charts through the copious amount of homework that I know you're all doing, right? And absolutely never trade any market with money you cannot afford to lose. Okay, so because short video, we're going to get right into it, so let's get rolling. Yep, a quiz. A quiz. I've been doing this rather religiously in my Sunday presentations, so I'm going to do it again here. And I think I did it in one of the other presentations. Hopefully by now you all know the answers, but repetition. Now, because you can pause this, and I have a lot of material to go through, I'm just going to ask the question, and I'm going to basically count to 3, move on to the next question, and then blaze through those answers, all right? Number 1, this business is all about the what. Very important. The market maker's entire job, their entire game plan, how they make their money, in one sentence is to what? What do they do? The method, how you're supposed to trade the market according to BTMM, boiled down in one sentence is what? How do we do it? Okay, answer time. If you want to think about these on your own, pause. Number 1, the money. The business is all about the money. That's it. That explains everything. Number 2, the market maker's entire job, in one sentence, is to create a sentiment and act against it. And number 3, the method, how you're supposed to trade the market, in one sentence, identify the peak and trade away from it from 2 to 3 days. For 2 to 3 days. Sorry about that. That's it. I mean, that's the foundation. However, we've got one additional question this time. All right. What is one of the market maker tactics for creating a sentiment? Now think about this. We're going to be talking about the baseline bounce today. That involves the TDI. TDI is an indicator. So what might the answer be? Validating the technicals. Okay, that's going to be very important because if you don't understand how they validate the technicals, I think you're missing out on a big kind of aha moment for other people, for how they're screwing the retail traders. So it really helps you to kind of understand what you're looking at in terms of why would people be taking this the other way. It's clear to me it's going down. So keep that in mind. We're going to be talking a lot about that today. All right, now really getting into the meat of the baseline bounce, and it absolutely is your friend. Okay, so just give you a simple definition, and I know I've covered this and I've shown examples in other ones, but I really want this to be, the definitive, like, here you go, this is what it is. So you can point other people to it when they ask you. All right, so a baseline bounce is when after either a peak formation anchor or as a pullback during a prevailing trend, the RSI heads back towards the market baseline to tap it and reject off of it once again to go in the true direction. All right, so the baseline bounce acts as a strong indication or confirmation of a solid move that's about to come. Now that little asterisk there, that can actually be the top or bottom of the anchored pattern. Okay, you get a peak formation, your anchor's that second leg, right? Or the second shoulder. You'll see more in the chart examples, but just know that the baseline bounce can actually be that anchor, that second leg. And those, as we see here, another asterisk. Those are easily, in my opinion, the most powerful. They're my personal favorites, and you'll see them marked on my charts as 2L BLB or 2S BLB, which is just second leg baseline bounce or second shoulder baseline bounce. Just so you know that. Now, let's take a look at some charts. I want you to just take 30 seconds to look at this and see what you see. Do you see what I'm talking about? And then I'll point it out. Okay, hopefully it's fairly clear, right? Obviously we're coming out of a peak over here. We're getting into level 2. 50 has crossed the 200. We're working around, working around. Oh, it looks like it's about to go back up and they shift down. Now we get our level 3 and we start moving down into another level. Oh my goodness, peak. Well, right at the quarter point, they start working the blue tracer. What do we have? We have divergence, okay? And we get this formation on the TDI, shift up, we get our baseline bounce. Now, it does hit again, but that's not a big deal. That happens. Okay, one thing that's really missing over here is a clear kind of shift away from it. But if you're looking at the H1, you do want to see kind of a clear shift. And this is the H1 for those of you that may be looking at this goes, is this the 15-minute? Is this the 4-hour? What is this? This is the H1. Now, they come back, they hit it one more time. No big deal. It happens. But now they clearly stop past the tracer, past the quarter point, past the first and the second legs. Don't hit the low in front of me 3 times, that kind of thing. We get one final spike down towards the bottom. They roll over. They give us another hit the next day. Oh, this is the kind of stuff that becomes demoralizing. Oh, it's now. I thought this baseline bounce. Well, what do? They give it to you again. Now we roll over, and we get another one over here. But here's a variation on the theme. Okay, we have at least 3 clear pushes up, but we don't have 2 days of divergence. Do you notice all this divergence starts happening within 1 day? Now they start giving you a second leg, and that second leg becomes the baseline bounce. But I've talked about this before in regard to watching how they handle what you think are the peaks. Watch how they handle the middle. That's telling you, okay, it's a zone flip. It's at the sweet spot. You know, they hit the tracer and they started shifting down. Cool. Oh my God, I'm going to get in. I'm missing it. Well, look to the left and you'll see that they're working that price point. But what do? They go up one more time and then they give you a single leg peak right there. They give you just that one final push above this level 3 and then they roll over. This is a common variation on the theme where they do give you that baseline bounce, but because you didn't have the 2 to 3 days worth of divergence, it wasn't ideal. And you'll see this a lot. A clear, for example, on high M formation, second leg baseline bounce, and then switch slides too early. Then it doesn't really go anywhere, and the next one comes up a little bit right to the same level. And then they give you a shark fin and you get a single leg. Okay, so now we'll go on to the next slide. Okay, 20 seconds. Look, go. Okay, so primarily over here, once again, we have some of the same confluences actually. Here we have clear divergence, 2 days at least. It starts over here, so 3 days worth of divergence. Then it rolls over, and you possibly, I don't know, is that a baseline bounce? I don't know. Well, this doesn't really have very good level 3 behavior. All right, and there's not a lot of confluences. Yes, it's an M. It's over the 13. It's hitting the tracer. Okay, it's 50 pips below the quarter point. Doesn't Doug talk about that? Maybe I could take this. Well, sometimes that happens. All right, sometimes you have. To me, when I see that, I'm like, you know what? There's a couple pins at the nadir there. It just doesn't jive with what I like to see. It's that larger quarter point up there. Do you see that thick solid line running through the yellow line? That's a 500 or a 00 or a 000. Sorry. So when they're that close to it and they're not giving me true level 3 behavior, I'm pretty much expecting them to go up to hit there. But what do they give us when they do? They hit 2 pins to the quarter point, bearish candle, right? One more continuation candle for the retail traders right here, closing back above the previous day's high, and then they roll over and we get our baseline bounce. So this is the kind of stuff I want you to look for. And just another thing I wanted to mention on the last slide. Again, this is kind of range-bound material, and I know some people, they get scared about holding this kind of stuff through here. But if you watched my market phase videos, you'll know that this is what they got to do. They got to get the larger moving averages to cross over to trigger the orders, then cross back over to trigger the orders, then cross back over to trigger the orders. So as long as I see this within a range-bound market, hey, I'm golden. All right, one more and then we'll move on. All right, take a look at this, 20 seconds. Okay, once again, 2 days of divergence at least. And this is almost synonymous with what we just looked at. The divergence it's not really divergent at this point, but the first point that you're measuring against, okay, starts on Friday. They move up, give you that divergence. It's not inside the bands, but it's much higher, flatter. Then they roll over, and again, could this be a baseline bounce? Well, it's a first leg. I'm not really a fan of the first leg baseline bounces. I'm just not. I want to see this second leg. This second leg, that's beautiful. It's starting to show you momentum, starting to show the retail traders some momentum back up. Oh, the trend is going to continue. So think about this on the hard right edge. This is starting to show angle and separation. The technicals are starting to be validated. RSI is above the fixed 50. It's scooping down a little bit, and then it's heading back up. Oh, we're breaking the previous day's high. I'm going long and pick up the pendings and they shift. What do we get? We get the baseline bounce. They hold into the next day. They show this fake ass W off the water right there. They're hitting any pendings past this previous area right here where people started going long after a bounce off the the water, right? And then they just shift and roll over. Again, the moving averages, it's kind of range bound. I don't really trust those. I love range bound, especially when I see this, because I know, hey, they got to pick up more orders. They want to collect for a while. So what do we get? We get move down, move down, move down, W formation. Again, 2 to 3 days worth of divergence, crosses over the market baseline, slams into the market baseline, shift up. Now, this is news, but it's still there. What do they do again the next day? 1350 no cross safety, baseline bounce. They showed everybody right here, think about the RSI traders, they showed them that, we were in a downtrend, right? It's going down, more angle and separation, and now it's crossing back over the fixed 50. The RSI is showing down once again. So, hey, everybody, go down. And look at those candles. Those candles to any kind of 1 hour normal retail trader with this momentum, they start going, see, it's going down. I'm missing it. Boom. Done. Okay? So, 3 great examples. If you didn't already, maximize your video, take the screenshots, study those, but we're going to be looking at some more. All right, on to the next. All right, so we're going to take a deeper look at the RSI. This might be This might be boring to some, and most people kind of think they already know everything regarding, like, oh yeah, RSI, it's supposed to do this. And I thought the same until I went back and I rewatched Steve's RSI videos, which, if you got the time, I recommend it. The RSI, the TDI RSI videos in the boot camp, go back, break them up, watch like 10 minutes a day, and just go in and homework the hell out of it. It's amazing. Okay, so let's take a look. Very verbose, but I'm just going to kind of skim over the most important parts I've underlined and bolded. So we know it's a technical indicator. We know it's used for the analysis of different financial markets, but you got to realize what it's classified as. It's a momentum oscillator. It shows momentum. It measures the velocity and the magnitude of the directional price movements. Okay, and it's the rate of rise or fall in the price. And we put it all together. Don't worry. Okay, this stuff. Typically, it's 70 and 30. We kind of adjusted it for the TDI plus. The guy who created it basically said that when price moves up very rapidly, okay, it's considered overbought, and when it price falls very rapidly, at some point is considered oversold. And that's when you're looking for like, oh, here's where the reaction is going to come. Now think about that for a second. The moves up very rapidly and the falls very rapidly. That's talking about the price. You've all been caught in a trend that just keeps going. And a lot of time those trends, they don't have the fast, hard moves. Or they do, but then it like holds for a week. So then the RSI kind of just like levels out again. That holding for a week gives them enough time to book their profits without reacting too far against the trend to book the profit, like say in a reset pattern. But you'll notice a lot of times in the larger trend moves that just it keeps going for like 2 or 3 weeks, a month, 2 months. It's just a lot of like slower moves that just ride along that 50, right? So that's why it's important to pay attention to the whole moves up very rapidly thing. Okay, yeah, this third one's pretty important. How the level is measured. I copied this from Wikipedia, so they use stocks, but basically Forex, any kind of trading instrument that you're looking at. The slope of the RSI is directly proportional to the velocity of a change in the trend. Okay, so the distance traveled by RSI is proportional to the magnitude of the move, and that means the price. It's proportional. Now, RSI, remember Steve has always said, like, RSI is great with the divergence because it's not buying it, quote unquote. It's not buying what's going on in the market. So while price may look big in its move, say, for example, that second leg that's creating your peak, RSI is like, you know what? Nah, actually, hold on. Let me check here for a second. Okay, 21 RSI. Okay, so let me look back at the 21 candles. Actually, you know what? In proportion to the rest of the move that came before this, it's not that big of a deal. So that's when you start getting the divergence. Okay, now this stuff, all fairly basic, but it talks about the RSI goes above the 70, drops below the 30, it's overbought, oversold, etc. Okay, but between that 30 and the 70 is considered the neutral with that 50 level. We have that fixed 50 level, which is typically a sign of no trend. And that's important. We already have a couple different points about different trades that use the fixed 50 for guidance, and like, oh, I say in the fixed 50, the TEDS 50, the AR 50, the different 50 is bouncing off that fixed 50, okay? But so keep that in mind for what I'm going to talk about in a little bit. And now, Wilder further believed that divergence between the two, RSI and the price action, is a very strong indication that a market turning point is imminent. Okay, we all kind of know this, but really thinking about how other people trade this is kind of important to what I'm going to be getting into. So what are you getting at, Doug? There's many different variations of systems based on trading the RSI, but there's some core foundational approaches. For example, or like identifying reversals and trend continuations. And, these involve the RSI levels. Like, have you ever really brought your, you look at the RSI or the TDI and you got your fixed 50, you got your 70 and your 80 and 30 and 20 or whatever levels you have on there. Maybe you use the old one. If you ever really put your crosshairs on there, you can measure, you can see like the different levels. It's like, oh, it's kind of like it's exactly like using the crosshairs on the price. Okay, so when I say the RS levels, that's what I mean. And of course, overbought, oversold, those coincide with the levels and the midline, as I talked about, and of course, divergence. Now, the baseline bounce usually occurs, listen up, after one of these other confirmations of an RSI methodology have formed. So, for example, traditional RSI training says, hey, this little thing happening on RSI means the trend's about to continue. But our TDI says, not really there, buddy. And why is that? That's because of the special sauce. Yep, the TDI with the market baseline, the fluid 50. That's one of the things that really got Steve fall in love with the TDI, because it has that market baseline, which is like a fluid 50. And he used to joke that's the real secret indicator. All right, so back to the technical validation. So RSI retail traders, especially the trendies, right? The trend followers, they're interested first and foremost with where RSI is located. Primarily, is it above the 50? Is it below the 50? Now, crossover signals in that regard, they're pretty big. Oh, it's over the 50, it's going up, or it's back, it's down over the 50, or it's rejecting off of the 50. Remember that. Oh, excuse me, a little gas there. It's going back down. Okay, so we have the edge of having a 50 that moves with the price, that moves. So therefore, our indicator tells us the reversal is happening well before they get that message, because they're getting that message during the reset. Think about it. Price has to move below that 50 before they even start considering that the trend has changed. And then typically, I've talked about this, how I look for the resets for price to be bouncing off the fixed 50 and to be creating hidden divergence. I look for two things. So the RSI guys, the strict, trend following guys, they'll look for a reaction off that fixed 50. So at certain points, me in my methodology of using that for the swing trading, I'll be looking for the same things that they are. But then they kind of keep it in mind that, like, oh well, we're below the fixed 50, so the trend is down. And of course, there's additional things that they measure to try and tell them that. But our market baseline, well, that helps. That gives us the forewarning that no, it's not actually continuing down. Now think about that. To understand how the technicals are being validated is a deeper understanding of the method. And, Steve always said that. You got to have that deeper understanding. And thus a strong belief and confidence in what you're looking at. So we know it's all about the money. We know they create a sentiment and act against it. And we know that they use the technicals to validate other systems out there. They know what, technicals people are using. So they manipulate the price and get those technicals to react in a certain way before, reversing. Now let's cover time frames and circumstances. Now, basically all time frames in context. Okay, primarily I use them on the H4 and the H1, but as I'm dialing down more often and catching my stuff on the 15-minute, okay, they do work beautifully on the M15. For those intraday anchors and confirming the continuation moves. The intraday anchors, for anybody that's like, well, what is he talking about, the intraday anchors? The actual stop hunt high drop, when it shoots outside the Asian box and it does its stop hunt for the day. That's the intraday anchor. And if you miss that, sometimes there you get that second leg and it happens to be a baseline bounce, or head and shoulders with the second shoulder that's done the baseline bounce. Now, obviously on the M15, you don't have 2 to 3 days worth of divergence. But here you can kind of, it doesn't matter. I don't even look at it as like, oh, well, you have to have 2 sessions of, no. As long as you have divergence and you get that baseline bounce, you're good to go. But it can also confirm the continuation moves, because sometimes you really don't get that divergence, excuse me, on the anchor. Say it shoots up 25 to 50 pips outside of the Asian range, forms the N formation. That's divergent, but then it shifts down and maybe you missed it. Maybe you weren't really sure. Maybe you got to the terminal late. Now you're looking for your ID 50-50. A lot of times that has the market baseline bounce. So again, this stuff, you don't have to just use it only on the H4 and the H1 in order to swing. But you'll also notice if you are using it on the H1 and the H4, you don't even have to swing it. It just, this kind of stuff actually just alerts you that, you know what, a big one's probably coming soon. So let me keep my eye on this. All right. Now, they are particularly useful for entry confirmations on second leg and second shoulders of advanced patterns as well. Excuse me, I needed a drink of water there. And as well as the second leg and second shoulders of 12 and 22 setups. Now, what to look for in price action? You need to look for peaks. You need to look for safeties. And, of course, you can use it for continuations of a strong trend, but you better have your higher time frame stuff down pat. But peaks and safeties are where it's at. Oh, I didn't even plan that. Um, that's primarily what you want to do. Now, I really noticed this for the peaks because peaks, they were my biggest, like, man, you're told to identify the peak, and Steve was always big on taking peak formation trades, level 3. I didn't really like them because I was constantly getting, I was shooting myself in the foot because I just couldn't. Is this the peak? Is that the peak? Well, I couldn't nail it. So now to really identify, excuse me, to really identify solid peaks, I look for this. This is my bread and butter. I look for this. I want to see this. And this is the kind of stuff where when it occurs, it's so high probability that, you don't have to really, sit around trying to hunt for stuff. This is the kind of confluence that you can look at and identify those 2 to 3 trades per week. And if you go back and homework it and go through, go back and pick 6 months and go through all the pairs for that 6 months. I tell you what, just do 1 month on the H1 for all the majors. Just pick any month, go back a couple years, a year, last year, 6 months ago, doesn't matter. Pick a month, go through all the majors and look, and you'll see this is great for peaks. Now, I know that last chart is kind of like, well, isn't that kind of everything? It is, but they don't occur all at the same time in every situation. It's learning how to read various things, including the situation. So the phase of the market, range bound or trend, cycle synergy, okay, we're in level 3, but it's also Wednesday, so midweek reversal. Remember, that's what I talked about, the cycle synergy, because you got the actual market maker cycle and you have the weekly cycle. All right. And of course, the validation. Are they validating the technicals? Are they juking people out? 2, what price looks like in a given scenario. So level 3 behavior. Do you know what that looks like? The wide range swings, final push momentum on the second leg, the actual visible trap. Confirmed level 1, obviously for the safety trade baseline bounce, and for the continuation, you want an obvious strong trend. And what TDI, you need to know what TDI looks like before an impending bounce, which is, divergence. So let's take a look at primarily the rules, and then I got a couple more slides, and then we'll get into some charts. All right, so peaks. And that's all I'm going to be talking about today because that's the most important. Remember, question number 3, identify the peak and trade away from it I keep saying that, for 2 to 3 days. Now, a couple months ago, I had a discussion with Carr, and I spoke briefly about this in the Sunday study group, but I want to get it recorded for posterity, I guess. But it was a great, excuse me, I don't know what's wrong with me today. Sorry, guys. 1 second. Okay. We were at lunch. We were having lunch with a couple guys, and one of the guys was a newer guy, and he was talking about peaks, and he was, man, I just can't identify the peaks, and I'm not sure, and what do you look for? And then Carr posited a question. He said, he goes, okay, what is the primary thing on the chart? And he's asking me, if you only have one thing to tell people to look for that you consider required, identification of a peak or knowing I'm in level 3, what would it be? Now, I was thinking about it. I was throwing out different things. I hadn't really thought about it in this way. And, of course, we got off onto another discussion, and then we all parted ways. But later on, it hit me, you know what? The one thing that I have to have, that I look and go, yes, that's peak behavior. That's my identification for a potential peak, don't forget, in progress, there we go, is divergence. Simple as that. That's really the biggie. And of course, extreme overbought, oversold divergence. That's what I kind of really truly like. So let's look at that a little bit deeper. Okay, Okay, so here are my rules in general written out, so you can just print it out. Level 3 behavior, that's wide. The wide range swings, at least, it's over the 13, above the 13. I like to see, that final inducement. I want to see where they held the level and then look like they were going to continue the trend on price. 2 to 3 days of clear classic divergence. Now, a little bit of an asterisk there. The previous 2 to 3 days is not required for a head and shoulder pattern because the head will usually break the last point of divergence. Or, what you would consider like the first point where you start measuring from. But here's where you're going to see that chopstick divergence that I talk about. All right. So on a head and shoulders, you get that second shoulder that's a baseline bounce. That's there. I love that. But that kind of trumps the whole 2 to 3 days of clear divergence prior. Now, there's another exception, and that's if there are 3 clear moves, like that 2 to 3 or 3 days in a row, 4 days in a row, bam, 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 where you see those 3 levels one after the other, and then you start getting some level 3 behavior, and the second leg is actually the baseline bounce. That can happen really quickly, and there won't be that good a divergence, but it becomes clear at that point. I'm not worried about the 2 to 3 days of divergence. But either way, TDI is in the extreme overbought, the oversold territory. RSI has shifted across the market baseline against the direction of the prevailing trend. That means, the trend we just came out of. So we got a peak formation high. We just came up, right? we just got done moving up. So RSI is now shifted down across the market baseline, against the direction of that previous trend. The previous trend was up. We're now crossing down. It hits or breaks the fixed 50 or the volatility bands. Now, this is not required, but it is strongest. I love those. But at the very least, I like to see continuation divergence on RSI, and we'll talk about that at another time, seeing as how I do have limited time. So, now here, the reason the divergence, the reason I brought up the conversation with Carr. It wasn't just to reminisce. The divergence is so important because going back to what we spoke about with the RSI, that is what is truly, kind of like links it all together. Where, remember I said, well, not that I said, I was just, kind of bringing up how the RSI is built. It's a momentum oscillator, okay? It measures the strength of the move in price in proportion with the last 21 candles. For example, we use a 21 period RSI. So that, divergence really tells you there's something going on when it's up there in the extremes. That's why it's so important and so crucial as that number one thing for what would you tell people to look for to identify a true peak formation. So that's really a crucial part of this, except for those those 2 exceptions. So keep that in mind, and when you go back and look for this stuff, really start to focus on the peaks and notice like that there's so many the good ones. They all have the divergence. The really good ones. There's very few, if any, that I'll ever take that don't have the divergence unless it's the 2 exceptions that I talked about. But I see a lot of people trying to take these peaks. Oh, I thought this was the peak. I was catching a peak formation trade. I thought this was a 12 trade, and it's like there was no divergence whatsoever. So it's really important to have that divergence, and that's why. So those are my rules. Print those out, and hopefully you have the 3 charts I showed earlier. And then we'll move on. We'll look at a couple more examples. Oh, I forgot. We had one more slide. In regard to the touching of the baseline, it does not have to always touch. Most ideal versions do indeed touch. And why is it the most ideal version? It's because it is actually something concrete. It's easily spotted. It's something you don't have to guess at it. Yes, it's hitting the baseline bounce and it's moving off of it. But in some contexts, less than 3 points away when the shift occurs is fine for me. And contextually, what I speak of is when it bounces off of the actual fixed 50. So think in your mind for a second, you have a peak formation high, you get your divergence, and it starts rolling over. And RSI, maybe the shift is really big, and RSI actually works its way down towards the fixed 50. It's already over the market baseline. Now the baseline is coming down to meet the RSI. The RSI kind of bounces off the fixed 50 and starts heading back up. Then it kind of stops a little bit short of the market baseline, and then it starts to shift over and crosses, mind you, over the signal line. Why would I take that? Because it didn't touch. How do you know that's the market baseline? How do you know that's the baseline bounce? Well, the reason I'll take that, and the reason I say contextually, is because of the technical validation that I talked about. What did I say they do with the RSI? The retail traders. They'll look at that and they'll go, well, the trend is up. And, okay, this is just a reaction. Look, it's bouncing off the fixed 50. So now it hits off the fixed 50 and it starts heading up. In that instance, if it misses the baseline, I'm not actually too concerned about it, as long as I get like a shift back over to the downside across that signal line fairly soon. If it just kind of hovers around, then I kind of wait until it touches, because eventually it will. But if I get a hard shift after that 50 rejection, then I'm in. But most ideal versions, it does actually touch. Okay, so let's take a look at some examples. Okay, so what we're going to do now is we're just going to go through some pairs and look at the month of October. I'm just going to see what happened last month in regard to the baseline bounce. Now, we're not going to be covering all the stuff, like, oh, look at this larger structure and that. We're just going to look for any legitimate baseline bounces as per the rules that I've set forth and what I like to look for. All right. So there is nothing really over here. However, I see this example and it strikes me as something that people might look at and go, oh, there's my baseline bounce. We start to see divergence. Now, this isn't, it's just not the kind of divergence that I like to see, and it's not 2 to 3 days beforehand. However, I do know that one of the exceptions is, hey, the second leg, if that's the baseline bounce, then we're good. But there's no, this isn't a second leg. Now, the second leg comes in over here, and it's kind of a near miss, and you might look and go, oh, well, you know what? Not really the perfect less than 3 pips. There is other stuff lining up. The quarter point, it's a little bit below that blue tracer and then shifts above. So maybe you're thinking about taking that long. But for the most part, I like to see, to me, level 3 behavior is kind of the same thing as the confirmed patterns on the 15-minute. But I like to see where it comes up near the 50 and then back down and then gives my second leg later for the actual level 3 peak formation behavior. So this really doesn't qualify. Remember, I like to see first level 3 behavior and 2 to 3 days of divergence. So now we get over to here. I just want to point this out. Here again, we don't really see 2 to 3. We start to see some divergence, right? But again, it's not 2 to 3 days worth of divergence before this baseline bounce. However, the other exception coming in, second leg is the baseline bounce, but it's lacking the level 3 behavior that I like to see. Once it comes up here and comes down here and gives me this second leg, now this isn't a strict baseline bounce, but we've already had our baseline bounce. And now we get a shark fin. However, I want to look at something else. Now remember, I spoke about how the retail traders get screwed by the market makers validating the technicals. So what do we have here? We have downtrend. This is downtrend mode, right? Angle and separation. We see that. We're under the fixed 50. The RSI traders are saying, okay, we're under the fixed 50, and now we're rejecting off the fixed 50. Every time it hits this water, we've been rejecting off the fixed 50. We're now in a strong downtrend. It's going to continue. So what happens over here? Well, starts to climb back up over the fixed 50, but it's hitting that water, and it's rejecting off the fixed 50. So this is what they're seeing. Now it closes below the blue tracer. Now we get a small like bearish continuation. Oh, it's definitely going down. I'm getting in. Holds a little bit, pings just a little bit below. Now we get our shift. What we see over here is the divergence going on. The baseline bounce, and we have the baseline divergence. Remember I spoke about that. The baseline is now heavily divergent with the water. And we get that little below the blues tracer right to the sweet spot, shift above the water. We're good. And we see how that played out. Now, you got to practice this stuff. You really have to look and understand what they're doing, or else you're going to get scared out here. Oh, they're doing an M formation off the mayonnaise, right? Well, again, what are they doing? Oh, look, it's going back below the fixed 50. I knew the downtrend was solid, and then they just take it away, and it's over. Now, they give you one more little baseline bounce over here, and I want to discuss this, because this is a good example of where the intraday traders can really take advantage of this on a smaller scale, and the swing traders, you got to be flexible, because we get 2 to 3 days worth of divergence over here, right? And sorry, right here. Bam, we got our second leg. It's a near miss, okay? But they're obviously holding the level. They're working that blue tracer, and then they shift. Now, if you're an intraday trader, you need to be able to see this stuff in advance. And when I was just talking to somebody earlier today about this, and when you start to see divergence, and it has shifted below the market baseline, you need to get it into your head through practice, through making flashcards, through working on this stuff on the hard right edge. You need to get it into your head that when you see divergence on the H1 and it has shifted over or under, the market baseline, expect that baseline bounce. Okay, you're now at the blue tracer. It looks like a continuation. Look at that candle. But you have it in your mind. It's right next to that market baseline. The baseline is starting to diverge from the water. We're getting baseline divergence. I could be looking at a shift here. So you're down on the 15 and the 5 minute and the 1 minute, you 1 minute and 5 minute guys. You're looking for these tighter entries. This is where you can really hone in and go, all right, you know what? I've been studying these baseline bounces, and they usually they're a precursor to a nice solid move. So let me really be looking at this. And then bam, kind of a pseudo railroad track going on there. One more hit to the blue tracer, and it's over. So you 15 and 5 minute and 1 minute guys, you could really take advantage of this. And in this example, if you're an hourly trader, because you work a 9 to 5, you can't be checking this stuff every 15 minutes, every 5 minutes. You're checking every hour. You're waiting for the shift over the 13 on the hour. You take this. Well, this is the kind of thing, back over to 13. Well, you know what? Looks like they're probably going to be going back up towards the high one more time. Now, remember what I said about true level 3 behavior that I like to look for the longer moves. I like over the 13, back up above the 13. You preferably hitting the water, working the water to make that larger M formation, their larger W formation. Now they give it to you. It just happens to be at the end of the day on Friday, and then they gap down. But if you're a 15-minute dude looking for 30, 40, 50, you're getting in up here, you're nailing it. So, all right, let's take a look at pound. There wasn't much on pound. There was some great moves, nice larger structure here, but again, we're not talking about that. This isn't a variation on the theme. Okay, we didn't get the 2 to 3 days of divergence beforehand, but the third drive up, I guess this would be considered like a 3-drive pattern, right? 1, 2, 3. When you see a clear 1, 2, 3 inducement like this, we're back below, and then the third hit, let's just call it the second leg. The last drive, okay, let's make the exception that the last drive towards the high, whether it be a second leg, a second shoulder, or in a 3-drive pattern, the third drive, that creates the divergence, and we get our baseline bounce right here. But once again, it's at the end of the week. It didn't continue much. Why? It's election time. They're going to be doing this. But everything there, this was beautiful. Any other time, I would have taken this no problem. We also have other confluences, right? We have the quarter point. Blueberry is intersecting with the quarter point, 50 pips above the quarter point. The stuff I can't shut up about. It's all right there. All right, so dollar Swiss. If I recall, there wasn't much in the way of ideal baseline bounces on the dollar Swiss, but let's take a look at this example over here. I don't want you to get too jumpy on this because, the problem is everything bounces off the baseline all over the place, all the time. I know that. You have to have it in context, and you have to ask yourself all the questions, all the rules that I put forth. Okay, so is there 2 to 3 days worth of divergence here? No. This happens right here. Is this level 3 behavior? No. It's consolidation. They're chopping, they're swinging back and forth, but it's in a tight range. It's not really level 3 behavior. Now, granted, if you're a 1 or 5 minute person, you're getting this off the high. Maybe you're looking at this and you're like, hey, you know what? That is bouncing off the baseline. It's at the tracer. Sure, you can grab your 30, but it's not what I'm talking about. This is not ideal, so you pass. Garbage. This was beautiful, but not what we're talking about particularly. This is actually wonderful. I love looking for stuff like this, these single leg peaks. Nothing else. Okay, on to the next. Dollar yen. This was a lovely setup, but it's actually really spread out. This is, one of the variations on the theme. But like I said, 2 to 3 days worth of divergence, unless, okay, what did I say? The head and shoulders is one of the examples. Second leg is the baseline bounce, or you have a head and shoulders. Head and shoulders because the head does not have to give you divergence. As long as you have the head and shoulders there, you can forego that rule. So what do we get? We get a shoulder, a head, and then a two-pronged shoulder, right? Can you see it over here? Shoulder, head, second shoulder. Now this second shoulder, divergent from that first one, we have chopstick divergence going on. What are the other confluences that I talk about? Outside the harmonic range, we get the head outside the harmonic range. This is pin, 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 pin. Above this quarter point, 50 pips above the quarter point at the blue tracer. Everything's lining up. It's beautiful. Hard shift. End of the week, not a big deal. What do we get? False move week beginning at the quarter point with our baseline bounce. They've already scooped below that fixed 50. Let's take another look. Apologies. Where is that? I'll go over here. I'll just click it. Okay. Let's take a look at the dollar yen right there. What's happening to the retail traders? We're up, right? Angle and separation. We're up. They're bouncing off the fixed 50. Oh, I'm going long. I'm going long. Oh, look, I'm going long. I'm going long. W's. Pullbacks. Okay? When we get over here to start the week, what are they saying? Well, continuation. It just dipped further below. They do that. It happens. Oh, it's continuation. Look at that little trap right there, that trap pin, right? I'm going to draw that box around there and leave that right there. Come down. Oh no, are they going down? Now they're below the fixed 50. What's happening? Okay, there's my confirmation as a retail trader. This is just another pullback. It's headed back up. People looking at price are going, see, it's going back above that 105. They do that one little pin into that pain point area, the last trapped volume before that. Now I'll go back to here. Look at that, 3 days. You hold it down to the next quarter point, and then it's back up. I tell you, these quarter points are kind of magic, right? So, but if we take a look at the 4 hour, I wanted to show you this on the 4 hour. See that little head and shoulders right there? It's a little bit more clear. Plus we have the blueberry on the 4 hour intersecting right there as well. It's lovely. Baseline bounce, chopstick divergence, everything's there. All right, let's take a look at Aussie. Oh, this was, I just spotted this. There we go. Nice little W on the 4 hour. You can see that 12 trade, first leg. You see the little two legs right there? Didn't quite come right down perfectly to it, but The divergence isn't quite there, but I see this larger structure right in the TDI. Shift above, little W off the baseline, boom, it's over. All right, Aussie dollar. I was going to take a look at this before, but it's kind of a crappy example. It's not really ideal. Simply, again, a lot of this stuff last month was all happening on Friday, but it's part of the game. It's what you got to deal with. We do have the divergence. Starts on this day, goes over into this day, 2 days, qualifies next week, right? We start to get, is it going to continue down? Baseline bounce. Now, this starts chopping. Why? Look at the moving averages. You have to expect this. But again, if you're a 15-minute trader, if you're just an intraday trader, you can see like, they're showing people that they're going to bounce off this blueberry, this water. They're going to continue back down, and they shift it away. We get our baseline bounce. If you're doing this, if you're using this for an intraday strategy, you can take this kind of stuff and book your profit easily. Now, eventually they do, all the way right back up to the quarter point, just like you might have expected, but holding. As a swinger, that's the stuff you got to deal with. New Zealand. This was kind of nice. This can very well get you into trouble, though, if you're not really monitoring your trades. Because, for example, they start to give you the divergence, right? Second day of divergence comes in, and then they shift over. Not quite over the 13. I do like some of the shifts over the 13 on the H1. I don't always strictly wait for it. You have to practice this stuff. You have to get comfortable with where you're comfortable entering. Also, you got to factor in the blueberries crossing right over there. They're going to be working this. If they didn't close hard over that, no, kind of not interested. But also the work in the blue tracer, there's a couple things there. But if you do take something like this, you take a shift on the H1, use your foot soldier, use your pullback pending, and even if you just got in right here and you held through all this, well, you closed out after it hard closes back up above the blueberry. What is that? 5 pips? Okay, not a big deal. Then you wait. You get back in. You take it again, as Steve likes to say. We get 3 pure drives up to that quarter point. We get another scoop of the baseline before it rolls over. And do you notice this right here? Little bounce off the fixed 50 to get the continuation traders excited, the RSI guys. Oh, look, you hit the fixed 50 there. It kept going up. This is just a pullback. Hit the fixed 50. It's about to go back up. And then it's over. I was looking at another one. All right, here's some divergence. Here's some nice divergence going on. Right in a nice big harmonic box. We get the divergence happening. That second leg. Working that tracer right off the baseline. I should probably switch the color of this, shouldn't I? Light pink? No. There we go. The yellow is kind of interfering with the baseline visual. Again, we see, hold that area. It's kind of hard. Let's take a look at it on the blank slate. So your harmonic was over here. You're a retail trader trading RSI. What are you thinking? Down. Angle and separation. Bouncing off the 50, right? Hit the 50, hit the 50. It's going back up. Oh, no, hard shift. Little ping below, like a pipette, right? One more pipette, and then it's gone. They do a little retest, but it's over. I had my auto scroll on there. So that's why, I really emphasize the understanding of the retail traders. Steve talks about stop thinking like a retail trader, and I take my own twist on that where, the market makers make their money by screwing over the retail traders. Well, they do that by thinking like a retail trader and then because they have to know, like, well, how do the retail traders think? Oh, they think like this. Okay, let's do that for a little bit and then screw them by reversing direction, creating that sentiment and acting against it. So I started really taking a look at things without the TDI, just using the RSI to get into the mindset of like, okay, how are they validating the technicals? So that's why I really am spending some decent amount of time emphasizing that with just the plain RSI. And I hope you take the opportunity to look for it yourself. Like, see if you can really, ingrain the understanding and see the damage that's being done by validating this kind of methodology on the RSI before they shift away. Dollar CAD. This was an extreme example. Okay. Again, no real 2 to 3 days worth of divergence, right? But we see 3 clear drives and then we see a 4th drive, and this is just monstrous. Boom, take it away. Now it's up to you whether you want to take something like that. You put a foot soldier in, do a pending, but this kind of news reaction right to that quarter point, just big, look at that. 100 pips, and then it's over. They barely pull back like 5%. Forget about 30 or 50%. They barely pull in 5% of that entire move, but they give you a nice baseline bounce. And by now, do you see? Right? Hopefully you're catching on. Right? Hit to the water. Oh look, they're rejecting off the fixed 50. Oh my God! Look at that news. I better get in. Thanks for your money. Take it away. So they had those retail traders thinking that they were going down off of that fixed 50. Boom. There we go. And they're screwed. This doesn't look like much on the normal RSI, but we have that TDI. We're expecting, hey, look at that. To get this into your head, to get this in, like, deeply ingrained in your head when you start to see this, some sort of rejection off of that fixed 50 coming into the baseline bounce, and then just, expecting. Now, you may be scared out of this, that's fine, but as long as you understand what's going on, you may look at this and, hey, you know what, the opportunity was there, but I passed, not a big deal. But as long as you get this into your head, what it looks like, do I see divergence? Cool. Has it gone back over the market baseline? Great. Now I'm expecting a baseline bounce. But if you already see 3 drives like this, or you see a clear level 3 behavior, and you only see a single leg, but it's working that fixed 50 and headed back towards the baseline bounce, the market baseline, then that's when you get it in your head like, all right, let me start looking for a potential second leg baseline bounce that didn't really have the divergence, but that's okay because it's an exception. Now, this requires a lot of homework, but it's a really solid setup, and I hope just showing you just these majors. I was going to show you some other pairs, but we're I think I'm a little bit over time now, and we're trying to keep it within reasonable time. But what I'd like you to do is take this now and go look at all the pairs, all the cross pairs, but even the weird pairs that most people kind of don't look at. And I don't mean dollar Mexican or euro SEK or anything like that. I mean all the combinations of the majors. Like, most of us look at like EJ and EA, EN, EC, all the stuff that you see down here, but how many people really look at, like, say, Swiss yen? How many people look at that at Aussie Swiss? Most of the time, most people don't. And it's understandable. There was one, I was looking for one. This is decent. We start to get to divergence, the second leg. The second leg, I'll go over this another time, but when the second leg gives you the baseline bounce and it doesn't quite work out, you're usually looking for a single leg peak the next day. And hopefully people made it this far into the recording that they catch that little bit of a gem right there. But again, this is lining up perfectly. 50 pips above the quarter point. We have baseline divergence. We get our second leg at the tracer, baseline bounce, and then, well, it doesn't really work out, but the next day, single leg, just up, and then right immediately back in. How does that work out? Aussie Swiss. Don't even look at it, but look what's there, right there for the baseline bounce. This was another one that I was showing somebody earlier today. Aussie CAD. Who trades Aussie CAD? Not most people. But we see 3 clear drives up into this area. What do we have? 2 days of divergence. Level 3 behavior over the 13. Not as beautiful as I like to see down to the 50, but we see a clear 22 trade. 2 legs, 2 legs. Baseline bounce. 1 more hit. Let's say you take it right here. Not a big deal. If it starts going back, oh well, you close and then it does it again. Cool, you take it again. It's right here in front of you. So I apologize for going over, but I wanted to get some of these other weirder pairs in there just to show you that this setup, this is why I like this setup so much and I don't shut up about it, because if you learn to see this, if you learn to teach yourself and get it into your subconscious that, man, as soon as you see divergence and you see clear level 3 behavior and you're already across the market baseline, expect that it's going to come back towards the baseline. Expect that it's going to give you, or it's going to give the retail traders an indication on their RSI, on their MACD, on their momentum oscillators that it is going back up, because our fixed 50 is way ahead of the crowd. The pack. That's the phrase I was looking for. We're ahead of the pack because our fixed 50 has moved along with the market, where their fixed 50 is down here. So we're getting indication that, yeah, that the turnover is happening now. Whereas they're going, oh, look, the continuation is happening now. All right, so look into that. Experiment with only having your TDI on there. Try and see through the bands and look at this and see what they're doing with the retail traders. And I promise you, you've seen so far just through these pairs. You can just wait for this stuff and you're going to get your 50, 100, 250 pips per week. All right? So practice up, make your flashcards. If you have any questions, email at btmmswing@gmail.com. If you're not in the car study group, contact Lauren, see if you can get into the study group. I'm in there. You can, contact me through there. But please study up, practice this stuff, and I'll catch you later. Ciao.